My name is Stuart Cable, and I chair the M&A and corporate finance functions for the technology and life sciences clients of the international law firm Goodwin Procter. I'm honored to serve as moderator today and for so esteemed a panel. And let me take a minute or two to just set the scene, and then I'll introduce briefly my panelists and hand the microphone to them. With more than $3 trillion of deal activity in 2014 and more than $1 trillion of deal activity in the first quarter of 2015, we are obviously in an M&A market that is robust by any measure. A few characteristics. In the first quarter of 2015, mega deals, deals with values in excess of $5 billion, accounted for a record 46% of deal volume, with healthcare and natural resources the big winners among verticals. Strategic acquirers are clearly being rewarded in the market, trading up regularly on the announcement of a deal, any deal. North America remains the major driver of M&A activity, representing nearly 45% of targets in the first quarter of this year. Global corporate strategics are sitting on $5 trillion of cash, and PE firms an additional $1.2 trillion, with Wall Street more than happy to accommodate at reasonable cost additional financing. The prior cycle ran from 2002 to 2007, about 5 years, and ended with the financial crisis. We're now about 5 years into this cycle. So we have a star-studded panel up here with me today. Let me briefly introduce my panelists. To my right, Ray McGuire, Head of Global and Corporate Banking for Citibank. Peter Schoenfeld, to my left, founder and CEO of P. Schoenfeld Asset Management, an event-driven asset manager with $4 billion under management. David Solomon, co-head of investment banking at Goldman Sachs. Leon Wagner, chair and CEO of the merchant bank, the old school merchant bank, LWPartners. And to my far right, Steve Kruskos, deputy global vice chair for transaction services at Ernst & Young. So what we're going to do, at least initially, is give each of our panelists an opportunity to comment generally about where we are and where we're going. Ray, why don't I start with you?
I drew the straw. Great. In order to decide where we are, I think it's important to have some historical perspective. In order to engage you all in this discussion, what I'd like to do is to bring up slide one. To bring up slide one, which, if anybody who knows these things here, these are confidence monitors. So to the extent that we begin to fade, we look at these things and there's something that emits from that gives us confidence in what we're about to tell you. So here you see historically where this market is relative to how prior trends have occurred, the largest being what took place prior to the crisis in 2007. We got somewhat of a false positive in 2012, between 11 and 12, and today the data suggests that we're in the midst of, and that's absent some exogenous factor, in the midst of a boom era in a historical context. If we then go to the catalyst behind, if you go to slide 3, if you go to the catalyst of what's behind, what's driving this, on the left-hand side, you can see a segmentation of how the market is now valuing growth. And you can see that this is 2014 data, 2015 data is not much different, with a market PE, top left-hand side, of 17.6 times. As you segregate that out, 6.2 of that is the market's expectation of growth. 11.4 is base EPS growth. If you then look at the bottom, and you see the analyst expectation for EPS and top line growth, which is an aggregate 12% or so, and then you look at the sales growth of 5%, the delta is as large as it's been in quite some time. The market is expecting growth that it doesn't believe can be generated from baseline EPS growth, which then translates into how will you generate that growth? And that suggests that the way that you're going to generate the growth is through inorganic acquisitions. So that's a mindset that suggests that we're going to increase in the level of M&A activity. What are the catalysts behind that? We'll talk a little bit about the activists and in response to the activists, some of the early movers, CEOs as activists, whether or not they're reacting or being proactive, market, as I said, rewarding strategic actions, growth through an enormous amount of restructurings, confidence that's now in the boardrooms and the CEOs, where the agendas are more aligned today than they've ever been. And then what this suggests is some continued strength in European markets. The strength is a relative term. It is the lack of significant disruption in the European markets, especially given the economic easing that has gone across the euro economy. I think that helps set the stage of where we are.
Thank you.
The overall assessment is that we are closer to a boom period than a bust period. All the data would suggest that. The confidence level that exists in the mindsets of CEOs and boardrooms suggests that this is going to continue for a while.
Steve, jump in. From a global perspective, from the world of transaction advisory services, how do you see the world?
So from a global perspective, it's hard to disagree with everything Ray just laid out. I see, looking forward, a very optimistic landscape for M&A. And I'll give you a data point. We at EY do a survey every 6 months, which I shared with the panel, of about 1,600 very large companies, C-suite executives, appetite for acquisitions, and general landscape in M&A. For the first time since we've been doing this survey over 5 years, 56% of the executives surveyed said they plan a deal in the next 12 months. And that's against an average that normally is around, low to mid 30s, low 30s for the most part. So a dramatic jump, 56% say they plan to do a deal. Now, why is that? It's a number of the factors that Ray referred to. You've got economic confidence broadly, although it's a slow growth environment, there is some confidence and stability and that we are moving forward. You've got a lot of momentum set forward by the mega deals that we've all heard about, and that has brought more people into the market. And so ultimately, underpinned by those, there's three real drivers. And one is growth driven by innovation. Companies are doing deals to innovate because their core business is shifting constantly as sectors converge. Secondly, they're doing deals because of economic divergence across geographies, taking advantage of currency opportunity and taking advantage of growth opportunities across the globe. And third, there is an opportunity now to move forward and really grow the business beyond the organic base. So,
thank you. Peter, from an asset management perspective, how do you see the world?
Well, I agree with my two partners here in terms of the outlook for M&A. I think we're catching up, really, with respect to the level of M&A we would have hoped to have seen during this recovery. And so I think there's a lot of pent-up demand. And exactly what has led to this increased confidence at board levels, I think a lot of it really can be traced to the world being perceived as being de-risked to some extent, particularly in Europe, where there was hope for quantitative easing and to try to get Europe moving. And Draghi has been a very, very refreshing change. Quantitative easing is well in effect and moving forward, and looks like it's going to be with us for many years. So that risk seems to be out of the equation, despite the fact that in recent weeks we've gotten Greek concerns all over again. But generally speaking, I think boards have sort of gotten over the hump in terms of strategic deals. And we're seeing, some companies in some industries really pushing the edges of the envelope from a regulatory standpoint, trying to do really transformative deals. So that for us is very exciting. It has certain risks associated with it because each country and each region has their own sort of agenda through their takeover code and through antitrust interpretations. But I think until interest rates take serious moves and there's some real threat perhaps of a slowdown or some external event, we're pretty well baked in for a lot of activity going forward.
Leon, do you agree, or are you a contrarian here?
No, it's hard to disagree. I mean, I think that where rates are, the economy, et cetera, it's hard to disagree, Stuart.
Other thoughts?
Well, it's funny. I don't know if anyone here saw the Bob Iger interview of Stuart Grazer, his new book called Curious. And those of you who know me have asked me, they're curious why I'm on this panel, because I'm a sales and trading professional historically. I want to talk about the middle market a little bit. Drexel was built on the middle market. It was built on providing services to those borrowers and those seeking advice who were not getting it from the majors. I think we're in an environment very similar to that existed when Drexel really got going. There were a handful of banks. If you were an untraditional company or borrower or M&A client, you couldn't get access to the banks. And then Mike came and provided it, and everyone followed suit. I think today, post-08, you have a declining banking system, and as a result, you have, and plus the high-yield market has become part of the banking system, and as a result, and banks are going out of certain lines of businesses, and as a result, the middle market, I think, despite the fact that it's something in excess of a quarter of the M&A volume, a substantial number of companies are not getting that advice. So just as an aside, firms like Moelis and Centerview and, the new firms that have come together. So, at LWPartners, we are focused on the middle market as a merchant bank to co-invest with smart entrepreneurs looking to do deals. So we're a little down market from this.
David, we have a lot of optimism on the market. Do you concur, or do you want to head us in a different direction?
I'm not smart enough to really say what's going to happen in the future. I'd give you a perspective that's a high-level perspective on what's going on now and what's going on with M&A activity over the course of the last few years. And I'd say the high-level theme is there's a lot of pent-up capacity for activity because we've generally run way, way under trend. And I'm always a big believer that these things over long periods of time run to trend. And so if you looked over the last 25 years, generally M&A volumes have run on average 6.5% of market cap. And just last year in 2014, for the first time, we got back close to 6.5% of market cap, not quite to 6.5% of market cap. And you'd have to go back to 2007 to find a year when M&A volumes were at the 25-year historical average. So there's certainly a lot of pent-up demand. At a high level, I've always felt, and I feel this as I get around and I spend time with CEOs and boardrooms, confidence, CEO confidence drives M&A activity. And if you think about what happened in 2008 and the enormous kind of vacuum of confidence and then coming back out of the crisis, for a CEO that's running their business, they have a handful of things that they can do to basically answer the pressure to grow their business. The first thing is they get pulled along by the economy. And there's no question there's been an improvement in that in the last couple of years, but it's still a sluggish recovery. And so people are getting pulled along, but they're not getting really ripped along. They can pull the cost lever. And one of the very productive things that happened for companies broadly is because of the depth of the crisis, people have really been able to pull the cost lever very, very aggressively. And that's driven a lot of earnings growth in businesses. But a lot of people feel that they've pulled that cost lever, as far as they can. There's probably some room, but there's been a lot of that. And then they can invest their capital back into the business to grow organically, or they can buy growth. And at the moment, the market is rewarding people for buying growth. That creates a virtuous cycle of more confidence. And what do you know? You get a bunch of M&A activity. And so as long as the environment is benign enough to reward that, and we're in a pretty benign environment with respect to risk, I think you can make a strong argument that this activity will continue and potentially accelerate. But it could certainly, I give you 52 things that could derail it, tomorrow.
So let me follow up and push you, David. How much of the activity level and this optimism is a function of remarkably attractive and persistent capital markets. I have a CEO client who lost a bidding process a couple weeks ago, and he was kind of rueing the loss. And he said, I think I lost because money is free. Wall Street's willing to give every acquirer a lot of capital at a very low cost. So to what degree is that driving it?
The first thing I'd comment is Wall Street actually doesn't give the money. Institutional investors give the money. And so if money's free, it's because institutions are putting it out there in a way where it feels free. Look, we're in a very, very benign environment where there are negative yields in Europe and money's very, very inexpensive. There's no question it's had a big impact on some M&A activity. I think it's accelerated some things where people have felt that if we're going to do something and strategically it makes sense and we're paying for it with cash, better to do it now if it's something we really think needs to happen. But at the end of the day, I don't think that the cost of capital is really driving activity as much as the strategic desire for people to grow, find ways to grow, and the fact that confidence is high and people are going to move out the risk curve in the context of what they're going to do to support that need to grow and to move forward. It's natural human nature for CEOs.
And Ray or Peter, when the Fed moves, if they move, say, in, I don't know, September or January, does that change anything?
I don't, well, it depends upon, how much they move by, how fast they move, and I don't think it'll have a big impact because the underlying drivers of the market aren't changing.
Yeah, if it's incremental increases and reflecting strength in the economy, it could reinforce really the takeover effects. It may cause shifts in the currency being used, cash versus stock, but what we found is that companies have been extremely disciplined in the way they've structured their deals. There's still a big equity component in many of the larger strategic transactions, and that may be because markets are high and the cost of capital of equity is also on extremely low these days. But the transactions have been rational, and as David said, the acquiring company stocks have traded well because they've been effectively splitting the synergies between buyer and seller in an intelligent way. And the market has rewarded those companies who have been really thoughtful. Nobody wants cash these days. Can't even, as an asset manager today, we can't even get a bank to hold our cash, our excess cash. They want us to take it away from them because they're receiving penalties on the excess cash that they're holding. They have to have reserve requirements against deposits that we may lead there. And we've seen that experience in situations where we can discuss later where we've been active and activists occasionally in certain M&A transactions, and where we want cash return, perhaps. Some investors just don't want their cash because they don't know what to do with their cash at this point in time. But I think it's the discipline and the structure that's been rewarding. Again, the regulated environment is something that may change the perception because there are some pretty transformative and controversial transactions out there in the market right now.
The other point, when you define a Fed movement, the Fed would have to move in such a way that it would shock the conscience and disturb the confidence level that exists, at least in boardrooms today. If you put this in context, you've got a 10-year that's below 2, and you have a double B that is 200 basis points below the historical average, and single B that's 200 basis points below the average, and that's not where the activity is taking place. That just gives you bookends of the spectrum. So when there's a suggestion that if the Fed moves to raise rates, give me a sense of how far you think it's going to move. And in order for there to be a dislocation in the market as a result of that move, they'd have to move pretty materially. And it's not clear that there's enough strength in the global economy. There's not enough strength in the U.S. economy for them to make a move that is that material to disrupt the overall market confidence, at least for this segment of the market.
Stuart, Peter made a point about discipline, and I think that's worth coming back to. That is a difference, I think, between this cycle and other cycles we've seen. The amount of discipline and maturity that companies show around acquisitions, the level of planning and the work that's going into achieving synergies, realizing synergies, driving value, I think is at a whole different level than we've seen in prior cycles, and I think that makes a big difference about the sustainability of this cycle.
Well, Steve, that's what happens when the world almost comes to an end. People are a lot more deliberate than they were. Right.
Yeah, I just comment that I really agree with Ray that at the moment it's very hard to see, based on the current economic picture, the Fed moving in a very aggressive way. But I just, for one, would comment that given the unprecedented nature of the monetary policy environment that we're in, I don't think any of us really know what kind of effects will basically impact markets and what kind of volatility will come from a change in that monetary policy fundamentally. And to say that we're going to go through a shift and there's not a possibility that there's volatility and confidence breaks down and it could affect M&A activity and the distribution of outcomes, I think there's a big chunk of outcomes where that's possible. I'm not saying it's likely, but I think there's a big chunk of outcomes where it's
That last
possible.
note of caution. So let me change gears and let's talk about the buyer universe for a minute. So historically, there have been times in the cycle when private equity buyers have had an advantage. There have been times in the cycle when strategics have had an advantage. Today, it seems as if both worlds are bidding actively on available assets. If you look forward, if you kind of say, okay, what will happen over the balance of 2015 and 2016, does anyone see that changing? Does anyone see the corporates having a leg up, the PE guys having a leg up, or will it continue to be a full feast? Leon?
I think the status quo is continuing. You know, whoever's the best bid, whoever, you know, to your point of your client being a little upset that he didn't win, well, he didn't bid the highest. Why didn't he bid the highest? He didn't see it, you know, the same way the buyer did.
Other thoughts about the private equity world versus the strategic world?
Look, I think both will continue to be very active. We talked about some, you know, regulations on private equity lending earlier, and some of the which get quite complicated, but that could affect private equity's ability to play, you know, at a mega deal level. But I think you're going to see competition on the part of both. Corporates, as I said, have gotten better. Many corporates have taken the private equity model around value creation, and I think it'll be hotly contested.
Just from a cost of capital perspective, corporate strategics have an enormous cost of capital advantage to private equity. And you referred to the fact that there have been times where private equity has had a cost of capital advantage. I'm only aware of one time, which was basically kind of 2005 to 2007, where private equity had a real cost of capital advantage to strategics. Maybe back in the early 80s there was a period of time, but there wasn't necessarily, you know, enough activity to really point to that. So I'm more of a view that that's generally an aberrational environment where private equity has a cost of capital advantage. I think the big challenge for private equity on a go-forward basis, and there was actually a panel here yesterday that you had Steve Schwarzman, Jim Coulter, handful of, I think Leon Black was on it also, where they were saying that they are really having trouble putting their capital to work. Right. And there are a variety of reasons why they're having trouble. Valuation's one. The cost of their capital, given the regulatory environment around banks, is another. And fundamentally, if you look back and you look at how private equity expanded as an asset class, it expanded because of this aberration in 2004, 5, 6, 7 that led to these big pools of capital and put private equity in a position to buy companies, which was really not the activity that private equity was all about. Private equity bought divisions out of businesses, they bought smaller companies, but it really has never been about buying large-scale companies. And now you're funded with a capital base where really the activity is much, much more difficult. And for the best private equity firms to really survive, they've got to be much more diverse in their ability to apply capital, deploy capital than they have historically.
Yeah, they really do.
This really isn't a discussion today about private equity versus strategics. In the last cycle, it was driven by what David described as the cost of capital dynamic, which maybe was somewhat of an aberration. But if you look at the 2004 to the June of 2007, 2008 time period, was a leveraged buyout environment. That was a leveraged environment. Today, the largest LBO that we've seen to date is I guess it's the $5 billion Premier acquisition relative to the largest strategic transaction, which is an $80 billion Shell British Gas transaction. The top 50 transactions have accounted for 51%, it's 600 some odd billion dollars. The vast majority of those are strategic transactions. If you include the Kraft transaction, which had some elements of private equity to it, which is how the deal got financed, that gets included, but that's not by definition what's taking place today. By definition today, unlike what we've seen in the past two large cycles, this is a corporate strategic-driven environment.
And when you guys look ahead, by sector. You know, in the recent past, it's been healthcare, it's been natural resources. Are we going to see more in those sectors, or are other sectors going to become more active or prominent for the balance of 2015?
You know, it's an interesting question, Stuart, because what's going to happen is now that the oil and gas patch has cratered, I think you're going to see some of the private equity investors come in and try to create assets through the debt. Yeah. And, you know, we'll see how that comes in. Now, maybe a little early, you know, to do that, but certainly in the past, you know, Apollo has been very aggressive, you know, hit home runs oftentimes with Lyondell, et cetera. So
Well,
I think you're going to see more of that, you know, happening now.
Mm-hmm.
Certainly, that's where a lot of distressed players are mining these days, looking for opportunities. But as Leon said, I don't think we're quite there yet. But it is clearly showing up in the M&A world already. Ray referred to the British Gas transaction. We've seen a lot in the oil service sector, in particular, with Baker Hughes and Halliburton. We've seen Talisman get acquired by Repsol as a pure oil and gas situation. Siemens is buying Dresser. So there's quite a bit of activity in companies positioning themselves as a result of sort of the fear that drilling is going to be declining substantially, and there has to be some rationalization in that space. So I guess oil and gas will continue to be an area where we should be seeing some M&A, you know, metals and mining, which has undergone a similar kind of correction. We really haven't seen anything of major significance yet in that space, but I would expect that we should see something fairly significant in that area as well going forward. You know, TMT continues to be an area of a lot of activity. The CapEx requirements in that area are just astounding going forward into 4G, and some of the regulators for a period of time, at least, particularly in Europe, have been a little bit more relaxed about letting consolidation take place because they know they're kind of behind the curve in going into 4G. So I think we're going to continue to see activity there. You know, we just saw the Nokia-Alcatel combination on the equipment side, which looks to be a highly intelligent combination. Yeah, I think those areas are going to continue to be interesting. Healthcare clearly will be. We're seeing some hostile bids come into the market on the healthcare side, and certainly there's a whole universe of companies in healthcare that have inverted over the years and have distinct advantages over other acquirers, and they are taking advantage of it to their fullest extent possible. I think there's a built-in advantage to those acquirers that they're going to try to continue to exploit.
I was wondering whether anyone has an opinion on, you know, what's going on in Europe with the better economic environment, consolidation in the banks, whether you see that continuing, whether you see, you know, pickup in activity.
I think you're going to see more activity.
Happens to be one of GoldenTree's largest positions. So
I think you're going to see more activity in Europe because Europe's on sale. So, you know, I think you're definitely going to see more dialogue around activity in Europe. Businesses in Europe look cheap to global acquirers. So I'd be surprised if over the course of the next 12 months you didn't see more activity. And, you know, at a high level, you know, my view would be that you're going to continue that trend. That's a tailwind for that at the moment because I would guess the currency will be weaker 2 years from now than it is today, the euro, on a relative to the dollar. So, you know, look, I think that's a tailwind, and I think you'll see some more activity there. In terms of bank consolidation, you know, more complicated over there. And that's, when you think about all the areas that you mentioned, Peter, the one thing I just say, there has not been a lot of activity in the financial space because when you look, if you're looking on a dollar volume basis, you need big, large financial institutions to consolidate. There are probably a lot of reasons why you would be seeing that now, but the reason you're not seeing any of that is regulatory. And that regulatory constraint makes consolidation for financial institutions very, very complex and hard to see. Well, I think we'll see some pickup and some activity. It's hard to see a lot, especially with the larger institutions.
I mean, I think one of the differences I think we'll see, you know, jumping ahead to the next 12 months will be the shift in transaction volume from the U.S. to Europe. I mean, I think Western Europe will become much hotter. It is on sale, right? Currency, the currency environment's favorable. I think you'll see it across most of the sectors. And you know, the better question is almost what sector won't be active. It's tough to find one.
Terrific. Let's change gears yet again. So let's go to the world of activism. Activist hedge funds are posting cumulative returns well above hedge funds generally. 170 new activist hedge funds have been formed in the last 24 months. Third Point, Pershing, Elliott, Value Act have each raised billions recently, and collectively, those activists have more than $50 billion under management. Investor activism is increasingly instigating spin-offs, company sales, divestitures. So, there's a lot to talk about here, but let me suggest a starting point. I'd like to hear the panelists' perspective on how it's changing the views from inside the boardroom. How does it change the world of being an independent director of a company today?
Yeah, of which I'm one, but it's not going to be the target of an activist, I don't think. You know, it's interesting, Stuart. It may file something, I'm not sure what. It's interesting, Stuart. You know, the activists are, you know, kind of this generation's raiders. And they're the ones, you know, creating the point of interaction to really get the thing going. And, you know, some of them are the same from that era, Carl Icahn and Nelson Peltz, et cetera, you know, reconstituting themselves. It's interesting, in our discussion before, I'm not sure who said it, but you'll jump in, you know, that, you know, while activists may have gotten board seats, et cetera, in aggregate, in reality, maybe it was you, Peter, just they have not done inside the boardroom what, you know, they may have thought they were going to do, or what people think they're doing, that is creating panic, you know, in the boardroom. I think, you know, while board seats may be given, and you know, in aggregate, I think that Nancy Reagan, you know, just say no, or just, you know, just go along and get along has been the predominant behavior.
You really think that's the case?
I do.
Really?
I do, yeah.
My sense is that just given the level of activity by the activists, the mindset of boards is now, let's be a little more proactive, let's be a little more thoughtful, let's make certain that...
No, there's a difference between being thoughtful and being frightened.
I don't think they're panicked. I don't think they're panicked.
I'm just saying, giving a board seat is not the same as, you know, doing a full recap and, you know, paying out, you know, huge dividends and things like that. At the margin, they may be smarter and reacting, but it's not panic. You know, in the case of, you know, Carl Icahn acquiring Hain, you know, his position in Hain, you know, and he got a board seat or two, that was okay. The fact of the matter, Hain had to produce, and then they'd be fine. And they did, and Carl sold his position. I mean, you know, at the end of the day, I think that certainly they're thoughtful. You know a lot more about it than I do, but I think there's a difference between that and an industry changing, if you will.
Yeah, I wouldn't suggest panic. I would suggest that there's a dynamic now inside of boardrooms as a result of the activists that hasn't been there for quite some time. And I do agree with you. The activist, Carl, used to be called a raider, and then when he did Nabisco and generated a fairly sizable return, he now translated into a shareholder-friendly activist, or
right,
never shareholder-friendly, but he translated himself into an activist, and now the rest of them have taken on that moniker, and a small group of them have generated outsized returns.
Well, David, what's your view on inside the boardroom, you know, when a guy files?
I agree with Ray that what's going on with activism broadly is having an impact on boardrooms. And if you spend time in boardrooms today, that impact is meaningful. Boards are spending time thinking in a much more proactive way about where a company's vulnerabilities are. And by vulnerabilities, I just mean where their relative underperformances. All companies have areas of weakness and areas of relative underperformance. And I think one of the things that's happened because of this dialogue is there's a lot more focus in boardrooms to relative performance and where there are vulnerabilities. The one thing I'd comment on here, that just a perspective that I have personally, activist has become a term like Kleenex or Xerox.
Right.
And when you step back and think about what's going on here, there are some big picture trends that I think we're in the early stage of of kind of witnessing or watching them play out. And, when you talk about activists, Carl Icahn, to use Carl if you want, because you raised him, is on one end of the spectrum. And there's a whole range of people that are impacting companies in all sorts of different ways, some of which are, use the word constructive, much more constructive in the context of the way the dialogues work. Some of them are welcomed into the boardroom in a different kind of way. And so there are a variety of things that are going on. I think the trend, that's an important trend for CEOs and boards to really recognize, is that investors broadly are taking a much more active and assertive interest in what's going on with the company. And part of it is, if you were a shareholder, long money shareholder, and you didn't like what was going on in a company, the basic response was, I'll sell my stock or sell your stock. But actually, you can't do that today. And you can't do it because, one, the size of the capital pools are larger, and two, you've got no place to put the money. And so I think investors have rightly realized, if I've got a good company and there's a relative weakness in their performance, but I don't really like what they're doing, I'm much better to actually get involved and try to influence in a constructive way than I am to just sell my stock. And at the heart of it, that's what activism is really about in a much broader context. And that is having a big impact on directors and in boardrooms. Boards recognize they're being held more directly accountable for relative performance in both a long-term perspective, but also a short and a medium-term perspective. And I think that's a pretty big change.
Yeah.
Peter.
I think that's a keen observation, and it's really the investors who set the framework for the success of activism today. If you look at the S&P 500, somewhere in the neighborhood of 85% of the boards have been de-staggered, meaning that directors are up for election each year, which makes them extremely vulnerable to where institutions want them to go. And that's something that's taken almost a decade to overcome, state takeover statutes, poison pills, and all these artificial devices that corporations were hiding behind for such a long period of time. To a large extent, that's all been dismantled. And I think, it's important that boards get the proper advice now. For a long period of time, as Leon said, it was a just say no defense. Certain lawyers still reading from an old playbook, I think, out there and telling, boards to resist. But I think most people are coming around to understanding that a lot of these criticisms are valid and that they should be responsive to shareholders. I know we've ourselves led a few campaigns where we've had decent results, but just screaming and asking tons of questions isn't really going to be successful in the long run. The institutional investors are very intelligent themselves, and in the end, it's their vote that's going to determine in which direction a company is going to go. So we kind of know a fool can ask a lot more questions than a wise man can answer. So you have to have solutions. You have to have a well thought out plan as to how capital should be reallocated in these corporations. And regardless of how large your position is, if if your compass is pointing in the right direction in that respect, you're going to get a huge amount of institutional support. And in fact, the institutions themselves, in many cases, are the ones that sort of start the process. There are many activists that sort of get fed ideas from institutions who are frustrated with boards and just don't want to be the protagonist themselves in many cases. And if you look at the UK, where there have never been defenses, never frustrating actions permitted, it takes a very low threshold to call a special meeting to unseat boards and do things, and it never happens. The U.S. is somewhat unique in that respect, that the boards have been very slow to communicate well with their shareholder base, understand their needs. They still tend to resist to some degree, even though less than they have in the past. And I think there's a lesson to be learned for many of the boards. And as I look at the slide that Ray put out there in terms of the activists, I guess they were important early on. I think you're really underestimating to what degree they have had impact. A lot of them have been very quiet. As David said, there's a large spectrum of activism that's going on. In many cases, companies or asset managers are just writing letters to the board and trying to steer them in the right direction, trying to improve governance in some fashion or another. So just by looking at the number of spin-offs, That's one indication of the amount of future M&A activity that's occurred because of activist behavior. It's just a quirk of U.S. tax law that you can't sell subsidiaries here without taking on a tax at the corporate level. In Europe, you don't have those kinds of friction in the process, so you're forced to do a spin before you sell off a subsidiary. But there's a lot that's been going on behind the scenes by a lot of asset managers that normally wouldn't be deemed to be activists. They're just hedge funds who are frustrated with the way managements have delivered. So, it'll go in cycles. Certainly the highest profile people that are set up to be activists, it's a relatively small percentage of the asset managements that are out there, but there are plenty who are, speaking to the managements privately and trying to guide them in the right direction.
There's a point here, Peter, that you made that I want to highlight, which may be more secular than cyclical, and that is the engagement that boards have with the investors. Mm-hmm. And you said boards historically have been slow to engage. Today, there are at least two phenomena that are taking place. Mm-hmm. One is the importance of the lead director and how that lead director engages with the investor community. The other is how the board is more thoughtful about engaging with the investor community. My sense is that that's more secular than cyclical. Mm-hmm. Just because the overall investor community has gotten a lot more sophisticated, they've gotten a lot more involved, and in a low return environment, if they want to be more proactive in having these discussions, boards have had to engage. A lot less visible than some of the higher profile activist activity, but still much more of a fundamental part of how boards engage. Been slow to change, but I think now it's much more secular, much more part of the dialogue between the investor community and boards and senior management than we've seen historically.
I think the impact, Stuart, on capital allocation has been fantastic. And the way companies are thinking, because of activists, more proactively around how they allocate capital is something we haven't seen before. And the number of companies that are planning and putting together playbooks on how would we deal with an activist, doing the risk assessment up front, it's just something that didn't happen, right, a couple of years ago. So they've had, I think, a very positive impact.
Let's stick with activism for a couple more minutes here, and I want to dig a little deeper and go a little more granular. So, the activist playbook includes sale of the company, spin-off this, spin-off that, recapitalization, mega dividend, and obviously every situation is different. But when you kind of think about where activists have been effective and where you think they will focus their firepower in the year ahead, where will that be in terms of tactics, and where will that be in terms of industries, or is it entirely industry agnostic?
I think it's industry agnostic. I think it's more company specific. I think you'll see more spread across Europe. I think you'll continue to see a fair amount in the U.S. And I think a large part of it, back to the whole portfolio capital allocation issue, I think there will be continued pressure on spin-offs, on divestitures, on recycling of capital. Because again, if you're not shifting your core business, given the rapid changing world that we're living in, and you're not reallocating capital constantly, you can't stand still. You're going to lose.
Mm-hmm. Other thoughts? Tactics, industries?
I think it's moving to Europe. I know we just went through one that settled about 2 weeks ago with Vivendi on a company that we'd owned for 2.5 years, and everyone said, "Don't go into France. You're going to get annihilated." And we spoke to a couple of investment banks to try to get their support. Nobody wanted to represent us because they said, as you climb up that wall, the oil will be poured on you very quickly. But in the end, it was a company that had done a brilliant job in streamlining their business, and we were very much on board and had written letters to the board for a long period of time. And then a real activist, Vincent Bolloré, increased his stake there. And the quarrel was really over distribution. They were sitting there with $18 billion in cash and marketable securities, which we thought was an extraordinary amount, and were prepared to distribute a relatively small amount. And it was really over debate. How much should be distributed. And you have to really be familiar with the quirks of each of the countries that you're dealing with. In this particular instance, dividends are subject to shareholder vote on ratification, and the company was trying to ratify a relatively modest dividend of €1, and we thought something in the neighborhood of €7 made more sense. And we ended up compromising in a relatively short period of time because there was an annual meeting coming together. But, and we ended up negotiating with them over the Good Friday weekend at around €5. But the surprising thing was the press was very supportive, which is unusual in Paris and in Europe. And it was a relatively modest disagreement. We all had a lot of admiration for the job the company had done in distributing, but they just wanted a lot of latitude going forward in terms of how they keep what amount of capital to keep. And
now, Peter, do you think that's a one-off, or do you think you see a trend there? Because the rules are so complex and the takeover panel has such an input on how these transactions evolve. The example that you cite, do you think there's going to be more of that, or?
I think there will be more. I just don't know. Some people, someone mentioned Elliott Securities. They've been active in Europe over a fairly long period of time. In our case, we're only involved when the company has moved in a specific direction, and we're attracted to them because we think they're doing the right thing in some fashion, and it's just a question whether they're taking baby steps when they should be taking giant steps, or whether they've negotiated a fair deal for all parties. A little less than 2 years ago, we had a quarrel with Deutsche Tel in the combination with Metro PCS and T-Mobile, and we thought, they had the contribution analysis was all wrong, the capital structure was all wrong in the company going forward. Deutsche Tel was just in a very strong negotiating position, and they exerted just too much influence. The Metro PCS board was weak, and so the shareholders took over the process and said, you know what, we'd rather be independent than accept these terms, because we thought the company would be, Spectrum was worth more than the value that was given. And in the end, they restructured the transaction, and they've since come to the capital markets to raise equity at least twice beyond that. So despite the fact that we had delevered the pro forma capital structure to some degree, they still had to come to the equity markets. The company's done extremely well, as you know, competitively. They've taken on market share, and that was a quasi-European as Deutsche Tel, obviously, but it was a U.S.-based company. So I think it'll increase, but the more reactive companies are, the easier it is to diffuse the activists. And as long as you can anticipate, Steve, as you were saying, that you're advising companies as to what they should expect, what the capital allocation is, it's going to be easy to diffuse those companies that respond. They'll be able to diffuse the activists rather easily going forward by anticipating the moves. It's just hard to get boards to do things without being pushed very often.
Let me transition the conversation one more time and ask each of the panelists to think ahead. So a year from now, we'll all hopefully be back in this room as attendees or as panelists at the Milken Institute's M&A panel. What will surprise us? What will be different? Where will the hot industries be? What will be the new trends? What alternative tactical approaches will we see in the year ahead that we haven't seen in the year past? And let's go kind of right down the line. Steve?
Look, I think we talked about a couple of the major themes. I think you'll see a shift to Europe. I think we'll look back a year from now in the last 12 months and say it was a very strong year for M&A. I think you'll continue to see mega deals, but the mid-market deals will really be the engine, right? That's where you'll see the majority of the volume. That's where you'll see 80% of the action. Deals that don't seem all that complicated and don't seem all that edgy, maybe are more complicated than you think. As again, you look at the forces of sector convergence and the pace of change, and we say it over and over again, but it really is happening faster than ever before. So whether it's a foods business acquiring a more healthy brand, whether it's a life sciences business, expanding their portfolio as their R&D platform evens off. technology intersecting with automotive. There was a deal announced this past week, in chemicals and a microbiome acquisition. I mean, you're going to see types of acquisitions that you don't see as non-core, but they really are expanding the core of the business, and that'll be a big part of the story, because to stay competitive, you're going to have to continue to move your business as sectors move and converge.
Ray?
Yeah, the suggestion about Europe, maybe. The largest percentage that Europe has represented of the overall market is 35% at the peak of the market, which was 2007. So I query with that. Middle market, I query with that. 51% of the deals that are done today by 50 largest deals, $622 billion. Middle market, maybe, not quite certain. Valuations may have an impact. Today, if I look at the highest multiple of EBITDA, happened in the peak of the cycle at 12 times. Today we're at 11, so maybe we're getting a little frothy here on valuations, maybe, but for so long as interest rates remain where they are and so long as the investor base is looking for growth, my sense is that the strategic imperative will continue. I think North America will continue to be a large grower there, North America, and to some extent Western Europe. We've not talked about Latin America, where other than Mexico, it's not clear you're going to have a lot of activity. We've not talked much about Asia, North Asia, or South Asia, Australia. Maybe you'll have some activity, just given the attractiveness of that market. So the sense is you still have some big unknowns there, not the least of which is some exogenous geopolitical event that's going to drive the press and create a cloud over the overall environment. Activity should continue because demand for growth and interest rates should suggest that, given that 65% of the deals done today are done in cash, that there's going to be enough capital out there to continue to support the demand and the activity, and the necessity for these companies to generate a return would suggest continuance in strategic growth. As a sector, I'd continue to focus on healthcare. Healthcare today is, of all the sectors, up the largest percentage. It's up 100%. The largest sector, by the way, is industrials, but healthcare is reflective of the large percentage increase of activity. That's likely to continue. It is less correlated to all the other events. If you look at the top 10 deals, 4 of them are in healthcare.
Ray, let me follow up on a couple things you said that interested me. You talked about the frothy valuations.
Maybe.
Well, near frothy.
Maybe. If I look at percentage of the volume as a percentage of the equity, overall global equity markets, I think it's the statistic that David quoted earlier, you still got a little room.
And does that mean you're going to have fewer buyers at the table? Does that mean that the dynamic of an individual M&A negotiation is a little different than it might have been a couple of years ago?
I don't think you're going to have fewer buyers. I think most of these auctions you've had, especially the strategic options, you've had people, and one of his clients, he's lost by $1 billion, $2 billion. I mean, the necessity, what's driving this is the demand for growth, and corporations not getting it any other place organically. And
what about the form of consideration?
Form of consideration, historically, if you look at the long-term average consideration is 63 to 65% cash. In 2015, it's 65% cash, 18% in hybrids, and 17% in pure stock. If you look at the historical averages, you're somewhere within those averages. At the highest level that we've seen, the lowest level we've seen cash is 50%, and at that point, equity was 34%. Now we're at 65%, which is closer to the averages, and for as long as interest rates stay where they are, the likelihood is that cash is going to remain the dominant currency.
So let's start down at this end and continue the question. What will be different a year from now?
I think you're going to see a lot of activity. One of the sectors we haven't talked about is the BDC sector and some of the alternative credit providers. Blackstone buying GE's, real estate, a spinoff. They were the place to go, for a $23 billion purchase. I think you're going to see some consolidation in the financial providers. I think you're going to see some of the alternative providers coming together. There's going to be a lot of competition out there. It was interesting that, Leon Black on his panel, talked about at the end of the day when he was put in this position of what's your future call, he said bonds. I love credit, which, considering where credit is, was an odd answer, I thought. But that just shows that the lack of alternatives out there. So,
David?
Barring a market event, geopolitical event, something that changes the nature of, how people feel about where we are today, I'd expect we'd have a pretty robust year with strong volumes across most sectors. I do think you'll see more activity in Europe, but I think Ray appropriately points out that historically there's a cap to that, but we're still, off the top of my head, running around 25% of activity, 25, 27% of activity. So, there's some room there to see more activity in Europe. The one thing I'd comment on, since we had this discussion, on activism, just kind of looking ahead, there's been some noise. If you look at one of the things that activists have had a big impact on, it's the amount of capital that's coming back to shareholders. There's some noise on that now, and I think that noise is the debate around that's going to accelerate a little bit, especially in a world where people want growth. I think investors are going to start to be more open to some of that capital going back into businesses with a longer-term view instead of just coming back to them where they're struggling to get capital work. And so I think that debate that's starting to bubble up a little bit, I think in the next year you're going to hear more about that.
Interesting. Peter, we'll give you the last word, and then we'll open it up for the audience for 2 minutes.
Well, I'm guessing at this point in time, but I'm guessing that we'll probably see more hostile bidding than we've seen in the past, as people are getting more frustrated with managements coming to the table. The flow of deals may be quasi-distressed combinations, as I mentioned before, oil and gas companies who are, particularly small ones, who are, have debt covenants that get triggered as their reserves get revalued. Will be forced sellers this coming year. So it may be a different kind of M&A market. And I just can't help but think, considering how strong the markets have been, that there's going to be some kind of major correction in the market sometime soon. That's another reason why I think there'll be some more hostile bidding as pricing gets more attractive, and maybe even get private equity to be competitive at some point in time.
Peter, what do you think the regulatory reaction to that will be? That's kind of a back to the future, environment. I agree with you. I think hostile bids will come back, but I'm just asking what you think the regulatory reaction will be.
I don't think it's going. It's a big issue. It's company by company, state.
You got the big one now, right? You got Teva, Mylan, Perrigo.
Exactly.
Yeah.
That three-ring circuit.
Two hospitals, right? Two hospitals. Yeah.
We have 2 minutes left, and we'll take a couple of questions from the audience. There's a microphone in the back of the room. Someone must
we
have
can
a
go
question.
to the drink.
Yes.
Hi, thanks. First of all, great panel. I just wanted to know, coming off of 2008 and all of that, and the deepened regulation, the more stringent regulation, now it's 7 years, now we're coming up to a new election year, going to be close to 8, 9, 10 years. Do you think that these regulations will either be redefined or loosened, and will it help the institutional investor in the marketplace?
I think that's the best question I ever heard. I just want to let you know. That's my wife, just so you know.
A plant, is that right?
I didn't know.
Who would like to take a shot?
Great question. Right?
Great question. What's the time frame? What's the time frame?
Time frame to answer or time frame?
Time frame to answer.
Time frame to answer is a minute and 22 seconds. Right?
I think there are things that have gone on in the regulatory environment that have been constructive for institutional investors, and things that are certainly going to create headwinds for institutional investors. There's a big debate around liquidity because the big liquidity providers are in a different place. That's a debate I think you'll hear more about in the coming years. But the regulatory environment we have now, my big headline is it won't be the regulatory environment forever. But certainly in the context of the next 12 months, we're going to live in this regulatory environment. Mm-hmm. Over time, it'll ebb and it'll flow. At the moment, the regulatory environment, the pendulum's pretty hard in one direction, and that's having an impact on investors, on institutions, on market liquidity, but none of it's permanent. But you'll need more time to see the regulatory environment kind of adjust, and the way it'll adjust is when institutions and end users of the market ultimately feel that the regulatory environment in some way, shape, or form is impeding them.
Right.
And that's actually what will lead to an adjustment in a lot of the regulatory activity around financial markets and financial institutions we see.
Other comments? No. One more question. Yes. Go ahead.
So you guys talked about, first of all, amazing panel. Within the TMT, there's the first T, technology part. How do you guys look at the technology M&A that you've seen in the past, like 24 months or so? Especially Facebook buying WhatsApp at a crazy valuation, Yahoo, AOL merger possible. So how do you see, given the underlying economy and overarching macro trends, are they rational or not?
Who wants to take technology M&A quickly?
Well, you know, I think it's hard to define these transactions and the pricing as rational or not rational because of the, you know, level of change that's impacting the tech industry, you know, the impact digital is having across a number of industries. So, you know, are you going to see valuations in tech that, you know, look unusual? Sure, you will. But, you know, it'll continue to be a fast-paced and high-volume sector.
You got to look at the verticals. Are they looking at semis or software and internet? You see one of the largest transactions to date is a tech transaction, an XP transaction. So the sense is that in some data technologies, you are likely to see more activity.
And will probably be the next, and probably, Ray, be the next distressed sector as well.
Thank you, panelists. Thank you, audience.
Thank you.